Hi, Jim Kruzan here, and welcome to this quarter's Capital Market Review. This will be for the fourth quarter of 2021. And Happy New Year. As we do every quarter, we want to take a look at bits of economic data to get a better idea of where we are. And certainly this quarter has been somewhat of a wild ride. We came off of really low economic activity in the third quarter. In the first two quarters of last year, we had really rapid economic growth, but then everything kind of hit the wall because of supply chain issues and also concern over both the Delta and the Omicron variant. But then as we moved into the end of the year, things started to gain steam again. As we do every quarter, we come up with a theme that best encapsulates the data and the concerns we have at present time. This could easily be a question mark as well, as the theme this time is accelerating over the winter. What will accelerate over the next couple of months? Will it be the COVID variant? And what impacts will that have on our economy? Or will we start to see a continuation of economic growth as we saw during the first two quarters of the year and also the last part of last year? We do these because at the end of the day, the economy matters. In this presentation, we're going to dissect several major components of our economy. We'll talk about corporate growth, job market, corporate profits, inflation, and interest rates in the hope of getting a better idea of where we are today and also where we're heading. Because many of the accounts that we manage are retirement-based accounts for folks who are either very close to retirement or currently enjoying their retirement. We want to grow the assets, but we also want to protect them as much as possible against big downswings. Because of that, we want to get two things right: where we are in the economic cycle, as each and every one of the different adjustments to the economy present opportunities and threats, things that we would want to overweight and own, and things that we'd like to own less of or avoid. And we also need to know where the Fed is. Are they loosening and stimulative, in which case they create a wind at our back? Or are they starting to tighten and restrict, which at some point could cause economic growth to pause, or worse yet? Today's agenda, we're going to cover essentially 5 key components. We'll have a quick pandemic update, see where we are presently. We'll talk about fiscal policy, government spending and programs. We'll talk about the pace of recovery. It's important to look at how much we've recovered already, as well as how much more there is to go. We'll talk about monetary policy. That's the Fed and Treasury and interest rates and money supply. And then we'll talk about the markets, in particular the equity markets and what valuations look like and why diversity is important. And throughout each, we'll talk about the risks, threats, opportunities. So let's get started and let's talk a little bit about this pandemic. Well, we've looked at these charts several times now, and this chart represents a 7-day moving average of both confirmed cases as well as fatalities. It would be really interesting to also look at hospitalization, as hospitalization rates are more in line with case count than necessarily fatalities. But as you can see from the blue line, the first chart, which represents confirmed cases, it's gone parabolic. And that in and of itself would indicate that this particular variant is quite contagious. Fortunately, when you look at the gray line, which is fatalities, that line would indicate that we're not seeing a surge in fatalities. So while it's contagious, it's not quite as dangerous. Now, what's interesting is this case count issue. Is it because we have a rampant amount of cases, new cases being developed? Or is it the fact that there's ample amount of testing opportunity, both with home testing kits as well as testing that might be mandated through work And there are a lot of asymptomatic folk running around who are quite healthy, who also have COVID, and they're becoming for the first time aware of it. It's interesting because I had a conversation today with a client of mine who happens to be a family practice physician. We were talking about her retirement plans and how things were going. She mentioned she is swamped with COVID cases. So I asked the question, are the clients or patients, I should say, who are calling, are they calling essentially because they're sick, symptomatic, and they want to test to see if in fact they are COVID positive? Or is it simply because they became aware that they were COVID positive through a workplace test where they were asymptomatic and they're simply calling in and saying, hey, doc, I've got COVID. What do I do next? And she said, actually, there are more folks calling in who didn't realize they had COVID, but have it and are asymptomatic. So the good news with respect to that is this is now becoming less of a pandemic and more of a general flu season type issue. Also, chart to the right kind of indicates where we are in terms of immunization. When you look at those people who have natural immunity because they had the disease, those who were infected and vaccinated, either became infected after the vaccination or elected to get vaccinated after the infection, and those who've been vaccinated only, we're at a point where we are, by population, almost 90%, which means 90% of us have some form of immunization. I think that's also one of the reasons that the hospitalization rates are quite muted. Since we're on the subject of pandemic, this is an interesting slide. It kind of talks a little bit about how bad it got and kind of where we are today. This is referred to as high frequency data, and it talks about consumer credit debit transactions, hotel occupancies, number of people seated in dining areas, and then TSA traffic. So think of that as entertainment, being able to get out and get moving again. And with all of these, if you look at the very end of the slide, you'll notice that they've all dipped down a bit. That was the stall in economic activity that we had in the end or middle of the third quarter. It continued a bit into the end of the year. Almost all of that was a function of COVID variants, both the Delta as well as the Omicron. But if you look at where we are today relative to where we were, let's say, 2 years ago, as we were dipping into this pandemic-based recession, we've recovered significantly. All of the areas are certainly higher than they were 2 years ago. And in some cases, all of them are higher than they were just simply a year ago. In fact, when we talk about consumer transactions, purchases, and whatnot, we're actually 13% higher than we were 2 years ago. We're at levels that are equal to pre-pandemic levels. So we recovered quite a bit. The thought is, as we move into the first quarter of this year, as supply chain improves, as the variant issues subside, we'll see a pickup. And at that point, in terms of economic activity, we should recover all of the activity in this space, entertainment, travel, etc. And then that will be normalized. This is probably the last bastion that has not been fully recovered. We will see that again shortly. Let's turn for a second to fiscal policy. Here, we want to look at certain projections going into the next year or so. At the very bottom of the page, we'll talk about GDP growth rates. They're expected to be heightened this year. We're getting still the tail end of this recovery, this reflation from really depressed periods of time. The expectation is the Treasury will see a 10-year rate of about 1.9. It's hovering around 1.6, 1.7 as we speak. Inflation will be tracking at something above 2%. which is the bogey, much closer to 3. And the unemployment rate will actually drop below 4. It is now 4%, is expected to be high 3s by the end of the year, mid 3s by the following year. But then longer term, the rate will more than likely creep back up. But the really interesting thing to look at is upper right-hand corner, federal budget surplus deficit. What it's suggesting is that the last 2 years, we had this huge spike in deficit, kind of just blew the budget because both administrations had incredible amounts of spending as a result of COVID. Much of that stops. Child tax credits stop. Extended unemployment stops. And as a result, the budget should be healthier. The economic basis should be a bit healthier in the years going forward. Obviously, this does not reflect Build Back Better, does not reflect whatever the infrastructure bill would look like. But even with those, since those are typically paid out over a 10 or more year period, we should see the budget become less problematic. It should be less negative in the next several years, which is certainly encouraging. At the very bottom on the right-hand side, it kind of shows the same thing, but as it relates to the accumulated deficits or our debt, it's no longer going to rise. It'll flatten. In fact, it may drop a little bit and then reaccelerate. The issue, though, is even today, we're at very close to 100% of our GDP. It would be nice to see that number down significantly. If you look at where we were in just the year 2004, we were at less than 40% of our GDP, our cumulative national debt. We're now at 100%. And in and of itself, that creates certainly some budgetary issues. If we look at the rate of recovery, we've recovered significantly. This hash mark that you see moving left to right in upward trend is a 2% trend line. That's effectively long-term GDP growth rates in this country going back about 20 years. And you'll notice that for the lion's share of that period of time, the growth rate was actually below trend, something less than 2%. It was a bit above that going into the financial crisis and has never been above that since. Although year-over-year growth has certainly been pretty significant. Then you'll see the big drop, which was the COVID-related recession, the pandemic. And then the sizable recovery, almost V-shaped. And then you'll notice that the slope has been a bit more muted the last several months, again, because of concerns over the various variants. That said, we're at a point now in terms of real GDP, where real GDP actually exceeds the GDP levels we had before COVID. That's a huge plus. Our economy today is actually bigger than it was before COVID. Additionally, with the fourth quarter numbers that are soon to be released, as well as the expectation of accelerated growth going into the first part of this year, remember the expectation is 6% GDP growth maybe this year, 2022. We should breach that gap, and with the gray line should now be at or should be slightly above the hash mark. It will close the gap and be at least at trend line. That's good. The problem, though, is when you get to trend line or above, it's very hard to continue with exceptional growth, above average growth. There's a lot of pressure to keep it at trend line or below. The real large growth that we've had several years is because we're clawing back from a huge deficit. So the thought is, with wage rate hikes, with interest rate hikes, with potential tax rate hikes, it's going to be very, very difficult to see the economy grow much above 2. And if you remember the prior chart, that box at the bottom right, or bottom left, I should say, you're looking at 2-ish% expected GDP growth rates long-term, 1.6, 1.3 in the out years. So we have to keep that in mind when we look at opportunities for investment as we allocate clients' assets. A lot of GDP growth is predicated on productivity and job size, the wage base of our economy. And we're having some real issues today. The chart to the left shows job openings. There are 11 million jobs available. If you look at the chart to the right, at the top, historic levels of job quits. Folks are simply staying at home, leaving work, feeling comfortable doing other things. And the amount of layoffs, that is employer-based layoffs or headcount reductions, are at historic lows. Employers are going out of their way to keep employees that they have while still trying to fill existing positions. This is putting a lot of pressure on labor, which is a huge component of GDP, and it's also putting a lot of inflationary pressure on this as well. And as a result, we're beginning to see that in terms of wage growth rates. This chart shows unemployment rates year over year and also shows wage growth. That is how quickly are wages stepping up and improving. The gray line shows the big spike in unemployment going up to almost 15% in 2020, and then the subsequent drop. As of November, the unemployment rate was 4.2. As of today, it's more like 4 on its way to 3.5. The blue line represents wage growth, growth in salaries, growth in hourly rates, etc. And because of the dynamics that we talked about before, high quit rates, low turnover rates, a lot of vacancies and open jobs, we're seeing the wage growth rates really spike. And they're at levels today that we haven't seen in 20 years. And while there's a lot of transitory inflation as a result of supply shortages, as a result of other COVID-related issues, inflating of inventories, this is more of an inflation issue that could easily stay with us for a longer period of time. Turning to corporate earnings, we've seen a huge year-over-year improvement. When we look at 21 versus 2020, it's as much as a 180-degree change as we can see. Margins exploded. Corporate profit margins increased 55% year over year. Revenues were up almost 17%. And companies really did not reduce or increase share count all that much, which is a way of kind of, from an accounting perspective, cheating and inflating the earnings numbers a bit. We didn't see a whole lot of that. So generally, total earnings per share, EPS, increased about 71%. It's important to look at that because that would suggest that valuations are quite high. Things got about as good as they can get. And it opens up some questions as to what does 2022 hold. Will we see continued improvement? If we do, improvement more than likely will look weak compared to the prior year. And what does that do in terms of consumer confidence? What does that do in terms of price valuation or multiple expansion? So we need to look at that a little bit as well. When we consider inflation, it is quite high. If you look at inflation, the headline number, it's almost 7% as it was registered in November, up significantly. The PCE factor, which basically is the key component, the key performance indicator that the Treasury and Fed look at, that is well above the 2% bogey or benchmark that they like to manage to. And it becomes it's becoming an issue. And while we expect inflation to subside over the course of the next several quarters, we do think that there are certain components of this inflation, especially as it relates to wages, which we just talked about, that may be with us quite a while longer. So the thought is we may very well see inflation trending at a much higher level than, let's say, what we've seen in the last several years. If you look at the trend line over the last 50 years, it's been a bit over 3%. If you look at where inflation has actually been the last 10 to 12 years, it's been, as we talked about before, somewhat under 2%. More than likely, we'll see something a lot closer to 3. Doesn't sound like a big difference, but if we had 2 and we now have 3, we're seeing effectively a 50% increase in the inflation rate, and we have to deal with that. Interest rates are going up. We know that there's a lot of news about that. There's stories about interest rates on a daily basis. The interesting thing is the perception now has changed quite a bit as the Fed is becoming more hawkish and becoming more aggressive in its fight against inflation. Because inflation is as high as it is, the Fed has made a couple of changes to their policy recently. The thought originally was that they were going to undo this quantitative easing. The Fed had been buying $120 billion worth of bonds a month, actively participating in the bond market, and effectively putting a ceiling on interest rates. They were not going to go up because the Fed can be, let's say, a less aggressive buyer. They can afford to overpay suppressing interest rates. They are now eliminating their activity. Originally, the thought was to the tune of about $15 billion a month. That is, they would reduce their bond buying by that amount, which is about a 6-month throw. That has been increased to about $30 billion. So now the thought is they may be done with quantitative easing as soon as the end of the first quarter, which then opens up the balance of the year to rate increases. So a year ago, the assumption was that we would probably not see any rate increases till very late in 2022, 1 perhaps. The thought then went to maybe as many as 2. Now, the current consensus is we might see 3 or 4 this year. And that could have an impact on growth prospects. It'll certainly have an impact on PEs. At some point, higher interest rates become an alternative to equity valuations. Right now, there's no other alternative, but there may be soon enough. As a result, we do expect interest rates to rise. But we're in a really interesting situation right now because of this high inflation. Even though this spike in inflation of nearly 6% probably is short-lived, we're in a situation today where it's very, very difficult for bondholders. As the nominal rate is quite low, 10-year treasuries at 1.5%. But when you consider inflation at about 5%, it creates a real rate of a minus, let's call it 3.5%. So effectively, money in a 1-year bond, you're losing 3.5% of purchasing power. The thought is we will see interest rates continue to rise. At some point, inflation will subside, and we will see some type of an improvement in those nominal rates. All the while, though, it's creating headwind for the markets. Speaking of markets, let's look at valuations. The S&P's valuation is quite high. It's trading today at about 21.2 times earnings. The historic long-term average is about 16.8. As we can see from this chart on the far right, PEs have come down a bit. That's certainly a result of the improvement in corporate earnings from the slide several slides ago. We had a huge surge, and as a result, it brought earnings down a bit. But it only brought earnings, or I should say PEs, down from about 22 times to 21, still well above long-term average, and a full standard deviation above that same long-term average. In fact, if you look at other methods of valuation beyond PE, things like the cyclically adjusted PE, or also called Shiller's PE, dividend yield, price to book, price to cash flow, all of those are trading at 1, 2, over 2 standard deviations beyond the norm. That's a note of importance, because generally, when you're buying equities at inflated valuations, generally the next several years, the expectation is much lower than expected returns. So it becomes more of a stock picker's market, an asset allocator's market, than just simply buy the market. The only thing that still is attractive or favorable as a method of valuation is the earnings yield spread, which is kind of an inverse of the PE. It's still positive and is trading a negative standard deviation. When we look at allocation, where to put money, growth versus value. Growth, including large tech, have certainly outperformed the broad-based market for several years now. And that outperformance accelerated the last 2 years. And it accelerated in part because of COVID. Think of big technology names. In fact, last year, 2021, I believe the stat is since May 1st, 55% of the S&P 500's return came from 10 stocks, all of which were technology-based. For the full year, about 35% of the market's volatility or price movement came from just simply 5 stocks. That's actually even more concentrated than it was in the late 90s going into .com. And we know how that ended. So right now, it looks like there's significantly better value in value stocks. You know what technology is? Value is, think of it this way. Generally, they make things that would hurt if you drop them on your foot. And as the economy grows, those companies tend to do better. They also, as a group, tend to hold value better in periods of time when we have higher relative inflation and a uptrending interest rate market. So one would hope that value continues to outperform. While the first few days of the new year is not a market, certainly that is the trend that is developing right now. Value is beginning to outperform growth. Another area that looks attractive or doesn't look quite as overpriced may very well be the international markets. Again, similar story. Grossly underperformed the US last several years, in particular this past year. But Europe should be recovering from COVID quicker than we are. They're ahead of the cycle. And we should see improvement in both growth and value over there. When you look at the markets, you will see generally from a PE perspective, and this is the second half of this slide, the right-hand side, you will see US, Europe, Japan, emerging market, China. We'll just talk about US versus Europe as an example. In the first diagram, you'll see the PE ratio in the US is 21.2 compared to a 16.8 average. So it's significantly above long-term trend, whereas Europe is barely above long-term trend. And in some areas, like China, below trend, Japan, below trend, and emerging market, essentially at trend. So we start looking at where do we get the best bang for our investment dollar. At some point, it may very well be the international markets. So we need to consider that as well. Last slide I'll present to you is this. And again, history doesn't necessarily repeat, but it sometimes rhymes. And I've been doing this long enough to know that I've got 38 years, this year, 39 years of experience. And a lot of what I'm seeing today is reminiscent of where we were in the late 90s. And this chart helps bring that into focus. This talks about valuation dispersion, valuations of the most popular stocks versus valuations of the least popular stocks. And you'll see it's as wide as it's ever been. The last time we had these kind of dispersions where you got a large or a small group of very popular stocks extending their PE ratios was back in the late 90s. And it widened out then and then came back in again. And it's now widening out now. So we need to consider value when we look at allocating assets. And there just aren't quite as many opportunities today as there were, let's say, 2 or 3 years ago. But we're looking, and we're working every day to find those opportunities. So again, what are the 2 things we have to get right? We need to know where we are in terms of the economic cycle. I think we're late stage recovery, kind of moving into more of a mature market. The Fed clearly is beginning to tighten. Think of it as we're at a party. The host still has the punch bowl out, but we notice they're no longer filling it or refilling it. At some point, that punch bowl will be taken away. Interest rates will start back up again, and we'll see where things are at that point. It'll also be interesting to see how healthy the economy really is without a lot of this cash being injected from a very accommodative government, both in terms of fiscal and monetary policy. Every week, we have an investment policy meeting, and every week we talk about where we are with respect to COVID, where we are in terms of economic recovery, and where we are in terms of the economic cycle. We talk about stimulus and spending expectations. There's still a lot of questions and few answers. We don't know where we are with the infrastructure bill, or at some point build back better. I'm talking about soft infrastructure. We're watching the 10-year Treasury very closely. At some point it gets above 2, it starts to create some headwind. We may very well see that as we move toward the end of the year. And obviously Fed policy is quite important as well. What is the Fed planning on doing beyond eliminating quantitative easing? How quickly do they plan on raising rates? As always, we appreciate your business support and confidence. We'd love to be able to offer the same for friends and family that you care about. We'd love to offer anybody the opportunity for a second opinion. Simply reach out to us at Kaydan Wealth Management or give us a call, and we can help get that conversation started. We use what we call the evolutionary wealth process. It's kind of a series of meetings, a particular cadence to make sure nothing falls through the cracks, that we are constantly improving one's path toward their retirement and financial goals. And again, we'd love to be able to do that for friends as well as family. If you have any questions about this or anything else, reach out to us at 810-593-1624. You can also reach out or leave a question on our website at kaydanwealth.com. With that in mind, I want to thank you. See you next quarter, and have a happy and healthy new year.